Welcome to the Deep Dive. Today we're looking at a stack of sources that really challenge the simple definition of interest rates.
They really do.
We're not just looking at them as the price of borrowing money. We're going deep on how they act as the fundamental steering mechanism for the entire global economy.
And that's the right way to frame it. The mission today is to shift that perspective because the sources we have, we're talking about the Bank for International Settlements, the IMF, they force us to see rates as systemic global plumbing.
Right, not just your local bank loan. So our goal is to unpack exactly how this one variable transmits policy through millions of, decentralized decisions all over the world.
Creating these ripples that very quickly become waves.
Exactly.
And the BIS, they put it perfectly, they identify rates as the central component of what they call global liquidity.
Global liquidity.
So any change by a major central bank, it just propagates through the whole system. It adjusts funding costs, and this is the key part. It changes how everyone, everywhere perceives risk.
Okay, so let's stick with that steering wheel analogy. When the driver, the central bank, turns the wheel, the effect isn't simple. It's not immediate.
No, not at all.
The policy works through 4 critical channels that we really need to get our heads around first.
Yeah, we can break them down into sort of action and reaction. The first one is the most obvious. Rates affect the cost of credit.
Okay, so who can afford to borrow?
Exactly. Then in number 2, they influence total spending in the economy by making saving versus spending either more or less attractive.
Right. And then you have the big one for investors.
The really big one. They fundamentally alter asset valuations by changing the discount rates for all future income. So think stocks, bonds, property, everything.
And the last one, which you said is maybe the most dangerous.
It is, because it's about financial stability. It either encourages or it discourages leverage and risk-taking across the entire system.
So when you look at those 4 channels, it's clear they don't operate in isolation. They're all interacting constantly.
Yep. They're interacting dynamically. They create these feedback loops, and those loops are what shape economic cycles and really determine the line between sustainable growth and an unsustainable bubble. That dynamic quality is key.
Let's get into the specifics then.
Yeah.
The IMF describes this whole thing as an interconnected system. So what are the actual wires and gears that turn a policy announcement into a real outcome for you?
Okay, so the first and the fastest mechanism is what's called the borrowing cost channel. This is the direct line.
The most immediate one.
The most immediate. Central bank hikes rates, and almost instantly, commercial banks raise their rates for mortgages, business loans, you name it.
So a business project that looked great at 3% interest
suddenly fails the viability test at 6%. And for households, higher mortgage costs for new buyers just immediately squeeze their budget for everything else. This happens fast, often within weeks.
Okay, that handles new borrowing. But what about the millions of people and companies who are already in debt?
Now that's the balance sheet channel. And this is the one that hits highly leveraged people and companies the hardest.
How so?
Well, when rates rise, it reduces the net worth of borrowers. If you have a variable rate mortgage, your monthly payments just spiked, which cuts directly into your disposable income.
And for a company with a lot of debt,
their interest coverage ratios, which is, just their ability to afford their interest payments, they get worse. That puts them at risk of a credit downgrade, which makes future borrowing even harder.
So if the balance sheet channel is about the debt you hold, the third one, the asset price channel, is about the wealth you think you have.
Yes. This is where the discount rate becomes so powerful. It's a valuation mechanism.
For all assets, right? Stocks, bonds.
Everything. They're all valued based on the present value of their future cash flows. When interest rates go up, investors have to apply a higher discount rate.
Because the risk-free alternative is suddenly more attractive.
Precisely. And that means the value of that future income stream is suddenly worth less today. So mechanically, bond prices fall. Equity valuations have to come down. And this creates what the OECD calls a powerful wealth effect.
When you feel poorer because your retirement account or your home value drops, you spend less.
You just naturally consume less.
The fourth mechanism feels less about the math and more about psychology. It's expectations.
Yes, and this is what accelerates everything else. If a central bank signals they're going to keep tightening policy, businesses don't wait. They might postpone building that new factory today.
And households might start saving more just in case.
Exactly. People front-run the full impact of the policy because they adjust their plans immediately.
And finally, number 5, the one that connects it all globally, the exchange rate channel.
So when a country raises its interest rates, its assets become more attractive to foreign investors.
They're chasing the higher yield.
They're chasing the yield. That brings capital into the country, which makes the currency stronger. It appreciates.
Which has a huge consequence for trade.
A critical one. A strong currency makes your exports more expensive and less competitive, which can really hurt manufacturing. On the flip side, imports get cheaper.
So the bottom line here is that the impact of a policy change is not one size fits all. It's highly variable.
Extremely. And the IMF points this out. The speed depends on structural features of an economy. Think about a country with mostly long-term fixed-rate mortgages. Rate hikes take a long time to actually hit household budgets.
But a country with widespread variable rate mortgages.
They feel the pain much, much faster. It's an immediate shock to household balance sheets.
So we see those immediate mechanics. But the real danger isn't in that short-term shock, is it? It's how long periods of low rates can distort behavior and create these dangerous boom-bust patterns.
This is where we get into the credit cycle, and this is the long, slow, insidious buildup of risk.
The IMF talks about this a lot.
Consistently, extended periods of low real interest rates are almost always associated with rapid credit growth, rising leverage, and financial imbalances.
Because when money is cheap, banks have to lend more to make a profit.
They feel pressure to relax their credit standards just to maintain margins. And that cheap money fuels asset prices, like real estate.
Which then feeds back into the system.
Exactly. Rising asset prices act as collateral, which allows for even more borrowing. It's a self-reinforcing credit boom. And the BIS shows that these financial cycles, credit and property prices together, they last 15 to 20 years.
Wow. That's so much longer than a traditional business cycle.
Way longer. And that long duration means the memory of risk just fades. Risk perceptions slowly erode. Highly leveraged projects start to seem normal, even prudent.
But then rates eventually rise, and the reversal is much more brutal than the expansion was. There's an asymmetry.
That is the crucial point, the asymmetry of contraction. The expansion is gradual, it feels careful. But the contraction is a dam breaking. It's not a slow leak. It's characterized by these sharp clusters of defaults and fire sales.
Which sounds like a nightmare for policymakers.
It is. It creates this non-linearity warning. During the boom, rate hikes might not seem to do much. The market looks strong. But then you cross a critical threshold when debt payments eat up too much cash flow, and suddenly those higher rates become, as one source puts it, devastatingly potent.
Let's focus on why this happens. The risk-taking channel. How do years of super low rates actually force people to make riskier choices?
The BIS calls it reaching for yield, and it's driven by pure necessity.
Okay, what do you mean?
Think about a pension fund. They have to deliver, say, a 7% return to their retirees. But if safe government bonds are only yielding 2%, they can't just sit there. They are forced to look for higher returns elsewhere.
So they have to move it to riskier, longer-term, more complex assets just to hit their targets.
Precisely. And this pushes valuations up across the board, sometimes completely detached from fundamentals. We saw this in the 2010s. Equity risk premia, the extra you get for holding stocks over bonds, shrank to historic lows because so much money was chasing returns.
And you can see this fragility building up in the corporate world. Right.
Oh, absolutely. You see soaring corporate debt to GDP ratios. And a lot of it is covenant-light lending.
Meaning less protection for the lender?
Way less protection. If the borrower gets into trouble, the lender has fewer options. You also see these huge maturity mismatches funding long-term assets with short-term debt. That's just a recipe for a liquidity crisis.
So if central banks are holding the steering wheel, why is the ride so bumpy, so unpredictable? The sources point to massive time delays that make this incredibly difficult.
Yeah, that's because the steering wheel has a huge lag. It's the policy lag problem. Monetary policy hits the real economy with a delay of, say, 6 to 12 months. But inflation can take 18 to 24 months to respond.
So policymakers are always flying blind, in a way.
They're operating based on forecasts, while the effects of their last decision haven't even fully hit yet.
It's like they're steering a massive ship while looking at where they want to be in a year, but only getting speed readings from the wake they left behind them.
That's a perfect analogy. And it's compounded by informational blindness. The economic data they get is always backward-looking and often gets revised months later.
So they make systematic errors.
They do. They tighten too late in a boom because the data still looks okay, or they ease too late in a bust because the stats haven't confirmed the disaster yet.
And what's really fascinating is that none of this happens in a vacuum. Policy in major centers, especially the U.S. Federal Reserve, acts as a global anchor.
That's the global synchronization factor. When the Fed raises rates, global dollar funding gets more expensive instantly. Capital flows back to the U.S. for those higher, safer yields.
And this puts emerging markets in a really tough spot.
An impossible trap. During low-rate periods, cheap money floods into these emerging markets, fueling their own booms. But when the Fed tightens, that flow reverses abruptly.
And they're forced to raise their own rates to defend their currency.
Exactly. They have to tighten policy defensively, even if their own local economy is weak, just to stop a currency collapse and catastrophic capital flight.
And the U.S. dollar's role just amplifies all of this.
It's a fundamentally asymmetric power. A tightening Fed raises the cost of about $12 trillion in debt held by non-U.S. borrowers. So foreign companies, governments, their debt costs go up in a currency that's also getting stronger. It's a double whammy.
So the big picture for any single country is that their own policy freedom is, well, it's highly constrained by what's happening globally.
It absolutely sets the boundaries. A small, open economy has very little ability to diverge from global interest rate conditions for long without risking major financial instability.
We've established the immense power of interest rates. Now let's talk about the limits. What can this steering wheel not fix?
Well, the constraints are fundamental. Central banks control short-term nominal rates, but their ability to control long-term real rates or productivity growth is actually very limited.
Those are driven by deeper structural things.
Exactly. Demographics, global savings patterns, fiscal policy. The OECD notes that even the massive quantitative easing programs after 2008 had pretty limited effects on long-term real rates. They stayed stubbornly low.
So monetary policy isn't a miracle cure for deeper problems.
Not at all. It can't pave roads, it can't fix a broken education system, monetary easing can't resolve productivity stagnation or institutional weakness.
In fact, the World Bank points out it can make things worse in some places.
It can. In economies with poor contract enforcement or high corruption, rate cuts might just mean more cheap loans to politically connected firms, not to productive ones. It just lubricates the existing dysfunction.
And then there's the limit we hit during the last few major crises.
Yeah.
The zero lower bound, the ZLB.
Right. Policy becomes pretty impotent when rates hit zero. Negative rates proved really difficult to implement, and QE started to show diminishing returns. Monetary policy kind of runs out of ammo precisely when you need it most.
Which leads to the final painful constraint, the financial stability trade-offs.
This is the constant conflict policymakers face. If you keep rates low to support jobs and growth, you risk creating dangerous financial bubbles.
But if you tighten early to prevent those bubbles,
You risk choking off a fragile recovery. There's no clean, simple answer. There's no perfect framework for balancing price stability against financial stability. It's a constant, difficult trade-off.
Okay, so to summarize our deep dive here, the sources confirm that interest rates really are the baseline global steering mechanism. They influence everything from, your mortgage to global capital flows.
But they operate with these huge systemic lags, massive blind spots, and a very dangerous nonlinearity when those credit cycles finally turn.
And understanding that dynamic is essential, right? Because you can't properly judge a country's economic outcome without first accounting for the global monetary weather.
You absolutely can't. A country's strong growth during a global credit boom might have had more to do with free-flowing global money than its own brilliant local policies. The external environment provided the fuel.
So that leaves a final provocative thought for you to consider.
And it's an important one. Since the global interest rate environment, especially the Fed's influence, is the same for so many countries, why do some handle the cycles so much better than others? The next step in the analysis has to be to look at how domestic institutional structures, effective policy, and just disciplined low leverage act as shock absorbers, mediating these powerful global forces to produce wildly different outcomes at the country level.